If I were to ask you, what is the thing that is losing you the most money when investing into stocks and crypto, you'd probably say something like investing into the wrong stocks or the wrong cryptos. In fact, a lot of the time it's because of you. The decisions that we make as investors are key to whether we're profitable in the long term. That's why in this video I'll be talking about market emotions and investing psychology. Make sure you stick around to the end of the video so you can learn how to make more money by understanding investment psychology. Wagwarn people, welcome back. For those of you that don't already know, my name is Benji. I'm a business owner and I was a university student, but I've recently submitted all of my coursework, all of my exams, all of that. So I'm done. Here, I aim to help you make more bread by sharing my own struggles, experiences, and advice. Alright, boom. So to make more money with your investments, you first need to understand investment psychology, which is why in this video, I'll be talking you through the cycle of market emotions. The cycle of market emotions is made up of 14 different stages, and it's key to understand where you are on it at all times, as well as the stage in which the market is in. So the first stage of the cycle is optimism. This is where you first enter an investment, you're gassed about what you're doing, what you've done, that you've made an investment, you're happy with the future of it and where you think it's going to go and how much bread that you're going to be making. You then move on to the second stage of the cycle, which is excitement. You're still gassed about the investment that you've made, whether it's stocks or crypto, and there's probably been some little upward movements that you've seen which get you even more excited. You start to see some profits, you start to think about future profits, and you start to think about how your portfolio is just going to continue to grow. From here, you then move on to stage 3, thrill. This moment in time, you're feeling great, you're feeling sick about your investments and the amount of profit that you're seeing, but this is one of the riskiest times for investors. You continue to see upward growth with your investments, and this is a point where you potentially may start acting irrational. Just like with alcohol or gambling or drugs or whatever, you can get addicted to investing. This stage, number 3, thrill, is where you're most likely to get addicted, where you just throw money at your investments irrationally. We then move on to stage 4, euphoria. This is the point of maximum financial risk. The investments that you've made continue to move higher and gets to a place you probably didn't think it would reach before you invested. You've made as much money as possible at this point in the current time, but you still think it'll go further. And sometimes you even throw more money at the investment at this stage. People are always wanting to buy when the markets are green, even though you should be buying when they're red. So many people want to buy Bitcoin when it was 60k plus, but when it's on discount at 50% off, people don't want to buy it at like 35 bucks. Stage number 5 is anxiety. This is the first moment when your investments start to come down in the cycle. The investments start to pull back, you start to lose some of your paper profits, and people get anxious. This stage in the cycle is a cycle where you should most definitely leave your investment unless you're holding for years. However, at this point, the majority of people are unwilling to sell because they think that the investments are going to reach the previous highs and this is just a little blip. From anxiety, we then move on to stage 6, denial. This is where the investments really start to pull back and people start ignoring the signs that the markets are showing. At this point in time, people start to feed themselves stories to suit the narrative in their head. They'll start telling themselves things like, oh, I'm a long-term investor, it'll bounce, or something like, I knew this was going to happen, but in truth, they didn't account for it. We then move on to stage 7, fear. This is where the majority of people's profits, paper profits, don't forget that, have been wiped out and they just don't know what to do. This is a stage at which people freeze and just don't do anything, but it's one of the last opportunities that they've got to leave with some small profits on their investments. We then move on to stage 8, desperation. This is where all of the paper profits that have previously been made are gone, wiped out. People often act irrationally. They see it as a last-ditch effort to do whatever they can to save their investments. You often see them trying to average down and add some more money to the play to try stay in the littlest bit of profit. We then move on to stage 9, which is panic. This is where the paper losses have really set in and people are just seeing their investments go down and down and down, more into the red day after day. This occurs because it's the point at which the herd sells, and so the investments just keep sharply dropping. People question themselves, the strategies and the investments that they've made, and overall come to the conclusion that, yo, investments ain't for me, it's a little bit of a scam there. If you follow the crowd and get sucked into a panic stage, then it's peak, but there's no real solution to it. Stage 10 is capitulation. This is where you just give up, you don't care on the more. You sell all your investments and you accept that the losses have already been made. The crowd continue to sell and investment prices just continue to plummet. There's so many big sell-offs within the market at this time. However, the panic selling does get worse in stage 11, despondency. People just want to get rid, as simple as that. They don't care about the price, they just want it sold. This stage is where the markets start to show signs of bottoming out, but people really just do not care. They just want to get rid. We then move on from despondency to stage 12, depression. This is where there's absolutely no sign of hope and people think that investing is not for them at all. At this stage, the crowd and the herd think to themselves, yo, investing really isn't for me. I am never entering the markets again after what I have just faced and witnessed. However, between stages 11 and 12 is a point of maximum financial opportunity. This is where the real bread is to be made. You've got the chance to get your investments on big sales after massive sell-offs. We'll then move on to stage 13, which is hope. This is where the market starts to rally and pick up again, but people are still tentative about entering into the markets after what they've just been through and witnessed. Investments are finally starting to go up again and people are starting to see small and slight gains, but due to the uncertainty, so many people miss out on the best opportunities to buy in and invest. We'll then move on to stage 14, relief. The herd and the crowd start to believe in investments again, and thus the investments start to pick up and start rallying. More and more people continue to enter the market even though they've actually missed the best times to enter while the investments were on sale. But the investments keep going up and will once again return to the optimism stage. So after knowing what's in the cycle, getting to understand it, you now need to know how to make money off it. While the best stages to buy are during stage 11 and 12 of the market cycle, despondency and depression. It's important to not follow the herd and the crowds. When others are buying, you should be selling, and when others are selling, you should be buying. Just by understanding the psychology of the market, it makes you so much more of a rational investor. Rational investors do the due diligence, get a plan, stick to it, and are confident with all their investments. They recognize attractive valuations early and remain confident in their investments throughout bear markets. You also become a disciplined investor and you're not tempted by panic buying when the markets are booming. You're able to stick to your long-term investments based off your due diligence and you do not make irrational decisions. In the worst bear markets, rational investors who understand market psychology just see opportunities after opportunities after opportunities. Making money from investments is all about doing your due diligence, remaining confident in your plays, not making irrational decisions and not following the crowd, and in fact, doing the opposite of what they are doing. If after watching this video you'd like to learn more about investing into stocks and crypto, be sure to check out this playlist. Love to everyone who's watched this far, and we will see you again soon.